Let's talk about one of the most misunderstood funding tools in business, equipment financing. If you're a business owner who needs trucks, machinery, technology, or tools to operate or grow, this conversation matters because too many businesses either delay growth or drain their cash trying to pay for equipment outright when better options exist. Equipment financing is not just about getting approved. It's about using leverage correctly so your business can grow without choking its cash flow. Let's break this down in a way that actually makes sense. First, what is equipment financing? Equipment financing is a type of business funding where the equipment you are purchasing is used as collateral for the loan. That means the lender is less focused on your credit profile and more focused on the value and usefulness of the equipment itself. This is why equipment financing is often easier to qualify for than traditional bank loans. If your business needs equipment to operate, trucks, machinery, construction tools, medical devices, restaurant equipment, technology systems, equipment financing allows you to get what you need now and pay for it over time. Instead of paying a large amount of cash up front, you spread the cost across manageable monthly payments. Now let's talk about why equipment financing exists in the first place. Businesses grow through tools. Tools create capacity. Capacity creates revenue. Without the right equipment, businesses stall. They can't take on more jobs. They can't scale. They can't compete. Banks understand this, but they still apply outdated lending rules that shut many businesses out. Equipment financing was designed to fill that gap. Because the equipment has value, lenders are willing to take calculated risk, even with newer businesses. This makes equipment financing one of the most powerful funding tools for small and mid-sized businesses. Now let's address a big misconception. Many business owners believe they need perfect credit to qualify for equipment financing. That's simply not true. While credit does matter, it is not the primary decision factor. Lenders look at things like the type of equipment, the age and condition of the equipment, how the equipment will be used, your business revenue, your time in business. In many cases, the equipment itself is the strongest part of the application. That's why equipment financing is often available to startups, growing businesses, and even companies that have been denied by banks. Please share and subscribe to Cube Capital TV. We break down funding, capital, and growth strategies so business owners can make smarter decisions. See you in the next video.